Welcome to Smart Spreads. Our goal is simple: to help traders better understand the markets, structures, and seasonal forces that drive commodity spread performance. In this video, we'll examine an important concept that can help improve trade selection, risk management, and overall market understanding. In the first two videos of this series, we discussed how to read forward curves and why carry often matters more than outright price direction in spread trading. But understanding carry is only the beginning. The more important question is how traders can actually use forward curves to make better decisions. While researching trading commodity spreads, I analyzed more than 31,000 historical spread trades and discovered something surprising. Forward curves are not just useful for evaluating individual spreads, they can also be used to evaluate the environment in which an entire market is operating. To understand why this matters, we first need to understand how different markets respond to the forward curve. Most traders assume that a favorable carry environment should produce similar results across all markets. The research shows otherwise. Natural gas historically performed best during periods of strong backwardation. As the forward curve became more negative, average profits and win rates improved dramatically. Lean hogs displayed a similar tendency. However, soybean oil showed almost the exact opposite behavior. Historically, spreads tended to perform better during periods of positive carry and worse during periods of extreme backwardation. Feeder cattle produced yet another pattern. The conclusion was both simple and powerful. There is no universally favored forward curve. Instead, each market appears to have its own preferred forward curve environment. Some markets perform best when the curve is strongly negative. Others perform best when the curve is strongly positive. This discovery changes how traders can think about carry. Traditionally, traders identify a spread first and then evaluate its characteristics. But because every spread within a market shares the same forward curve environment, we can evaluate the market before we search for trades. That leads to an important question: which markets are operating in favorable environment right now? Applying this framework to current conditions revealed several markets operate in historically favorable environments. These markets included crude oil, lean hogs, heating oil, and gasoline. This transforms forward curve analysis from a trade selection tool into a market selection tool. But identifying favorable markets is only the first step, because a favorable environment does not automatically create a favorable trade. This is where many traders have an opportunity. Forward curve analysis identifies favorable market conditions. It does not identify favorable trades. A market may exhibit an attractive forward curve while containing few spreads with desirable seasonal characteristics. That's why we combine forward curve analysis with additional filtering, including average profit per week, RIDEX, correlation, and historical risk-adjusted performance. When those filters are applied, the opportunity set becomes much smaller. After applying the Smart Spreads performance filters, only crude oil and lean hogs produced opportunities that met the historical performance requirements. Heating oil and gasoline did not. The process becomes forward curve environment, then market selection, then historical performance filters, then trade selection. The forward curve identifies markets of interest. Historical filters identify opportunities within those markets. And that leads to the most important lesson from this research. The goal is not to predict the future. The goal is to narrow down thousands of possible spread combinations into a small group of opportunities where market structure and historical performance align. Instead of starting with trades, start with markets. Use the forward curve to identify markets operating in historically favorable environments, then apply historical performance filters to uncover specific opportunities. When those factors join in the same direction, traders can focus their attention where the odds have historically been most favorable. In the next video, we'll continue exploring how forward curve analysis can be incorporated into a systematic spread trading process. Thanks for watching. If you enjoyed this video, visit bullstrangle.com for additional research, education, and the Smart Spreads newsletter. For a deeper dive into commodity spread trading, be sure to check out my book, Trading Commodity Spreads, which is available on Amazon. We'll see you in the next video.